Good afternoon. This is Brad Dennis with BIS Commodities with your weekly market wrap-up. Start off with corn. Corn's up 3 cents for the week. We've basically stayed in our most recent range though on corn. On the bullish side, we've got traders that are looking at next Thursday's USDA supply and demand report. There they feel that yield will be reduced, thus bringing ending stocks down some. They're also looking at that tight balance sheet. We're still hovering around 1.7, 1.8 billion bushels, which is a limited time supply for corn. And today they got an extra boost when the government released its baseline projections. Now the reason that we got a boost out of that is they were factoring in more acres than what came out. So even though we're jumping from an 89.2 million acres up to 92, that's still less than what the trade had factored in. So that gave us a little bit of a boost towards the end as well. Over in the beans closed up 27 cents this week. Beans are all about headline risks right now, and there's a lot of variables being thrown out there. Now, the last USDA report we had was October 12th. And at that point we sold off from $9, and then it took us all that time to get down to $8.40. Then in 2 days we came right back up to that $9 area, and I'm talking January's here. So what we did in about 14 days was corrected in 2 days by optimism over trade talks. Basically, that's what it was. Nothing was going to be resolved, but that icy relationship between the U.S. and China was starting to thaw, and the Chinese were willing to talk about trade. And this will take effect at the G20 meeting, which is November 30th and December 1st. Now, a couple things here. Even this morning and last night, there were more rumors flowing on about what is going to be presented at the G20 meeting, and that was kind of nipped in the bud with the Vice President's economic advisor today, saying that they're going to go to that meeting. They are going to talk about trade, but they're going to prepare for that meeting the same way they always would. So maybe that took a little bit of firepower out of the bean market to the upside. Now, so we talked about the Trump tweet and saying that it was very long and it was a productive meeting. Well, productive, he said it went along nicely. So Xi, who is president of China, comes in and says, yes, we need to talk about these trade wars because we don't want them escalating. Now, a piece of this puzzle that nobody's really been talking about too is the brand new president down in Brazil. And this brand new president down in Brazil, which is a hard right military guy, is not very fond of the Chinese. And he doesn't mind selling things to Chinese out of Brazil. He doesn't want to sell Brazil to the Chinese. So he's very apprehensive about Chinese coming in and doing infrastructure in Brazil and so forth. So with that relationship having turned around, maybe the president of China does need to come to the U.S. and say, hey, we need to make sure that we've got a source for this protein, because our once good relationship with Brazil might not be that stable going forward with this new presidency. Granted, these are all theories and such, but it's an interesting world that we're living in, and when one tweet can raise beans 30 cents in 15 minutes, you got to keep up pace with all the things that are happening, it seems like. So we talk about that, and possibly, hey, if they do get some kind of trade deal done, it's not going to happen until after November 30th. And with the enormous amount of planning that's already taken place in South America, beans in Mato Grosso should be coming out at the end of December. So our window of opportunity of where we export the most beans is closing quickly here. So when you look at it from that perspective, you also look at it as we're already 40% behind where we were last year. And the government right now is factoring exports at only 3% lower than last year. You know that there's going to be a reduction in that demand side of the equation next Thursday, and it's going to show a higher soybean carryout. Now, soybean yield probably will be reduced a little bit too, just because of the wet weather and in some of the major producing areas, but that'll pale in comparison to what the demand side will do. So that is, yield reduction is supportive, but demand reduction is going to be pretty bearish in our eyes over here. We'll have to see what happens with that, and that does come out next week. Wheat was up 3 cents this week, and wheat was basically being helped by better demand. It had the best export sales. It had some tenders to Egypt, so it is being looked at. The main thing with wheat is we need a softer dollar so that we can be competitive on the world basis. If the dollar is up, wheat is not going to be rallying, or I refer to the dollar index. If the dollar index is up, wheat's not going to rally. If the dollar index is down, then wheat has a chance to see a little bit of short covering out there. Cattle market. December cattle has been sitting around 116 to 119. That seems to be the range that we're caught in. Boxes have been on fire as of late. At the last today, we traded 218.50, 201.47 on the select. Excuse me. So widespread $17 spread between choice and select right now, but we're only doing 67 loads today. Didn't hit over 100 loads this week either. So those higher prices are not garnishing enough or a lot of demand right now. On the hog side of things, hogs are stuck, December hogs at that $60 level. It's starting to come off a little bit. There's a big debate on whether that 3 to 4% increase in hogs is really out there. Slaughter numbers are not saying that that is happening up to this point. If we start seeing slaughter get to 2.6, maybe we see that, then we'll be reassured that those hogs are out there, and that would probably be the key factor to say, hey, we might get down to that 52 level again in hogs. The S&P index, Dow, all the equity indices, varied earnings, trade dispute, wild rides out here. We've had our 10% correction. We're coming back off of it. I don't want to be a conspiracist, but you got to remember that on Tuesday we are going to have an election, and the in-charge party probably wants things to be looking pretty good for that. So I don't look at things falling out of bed there, but I also think that we'll probably start to stabilize this down the road. We did take out a big downward trend line today, closed above it, so we'll use that as support going forward. If you look at the Dow, even though the Dow was down 400 points today, came back only down 100, and you're still higher for the week. So technical traders will take a look at that as well. Another thing I want to talk about is bonds, and that's a lot of, it's kind of dictating a lot of things out there right now. So non-farm payrolls came out today. We were expecting 180,000, came in 250,000. So much better number there. But the number I want you to look at would be that wage, or the earnings number, that we're up 3.1% year on year. That's what kind of makes the Fed nervous. So the Fed looks at that wage number and says, hey, we've got almost full employment. All their wages are continuing to go up. That's going to create inflation. It's not higher commodity prices that they're looking at to say, hey, inflation is up. They're looking at wage inflation, and if wage inflation starts really ramping up, then they're going to be more aggressive with their rate hikes. Now they're factoring in one rate hike for December, but everybody feels that after that December rate hike, they'd have to pare back the ones for next year because of what the stock market has just done. Today, Maybe they're back on track to continue to raise 3 more times next year and get that normalization still going there. The president is very much against it, and we got to keep that in mind. He does not like the higher interest rates. He did not like higher crude oil. Crude oil's at $63 today. So keep that in mind a little bit. Look at those rates. Those rates are going to continue to go up based on today's unemployment results. And I would imagine that will keep the hawks talking about possibly going beyond 2019 with the rate hikes. But other than that, next week, a couple things on board. Iranian sanctions take place. We're going to see how that affects the crude oil market. Everybody knows that they're going to be in place, so hopefully it's a done deal. And then on Thursday at 11 o'clock, we do have a USDA report, supply and demand report. And with that report, we're looking at reduced yields in both corn and beans. Demand probably not messed with too much in corn, but demand lowered in beans is kind of the way that we're thinking right now. So we'll see that on Thursday of next week. Other than that, we have